All right, so once again in this question here, this is a little exploration, and we have two options for Jaden here to buy this, right? So we have, this is the balance right here of this new system, $26,23.95. The first option, option A, is the bank credit card that has an interest rate of 14.5% compounded daily. Okay, that's straight off. He's going to pay that all off with this credit card. The second option is a store credit card, which offers a $100 rebate, and a rebate is when you get money back, right? So basically, the total will be this minus $100, so $25,23.95. The interest rate is going to change, it's still compounded daily. Okay, so he can make payments of $110 per month. So on your graphing calculator, on the finance option, this is what it should look like, and we're going to calculate the total cost here in a second. But option A, here's the percent, 14.5%. Here's the total, $26,23.95. There's the payment. It's monthly. The payments are monthly. The compounding periods are daily, so 365 per year. So what you want to do first is you want to calculate the number of payment periods, which should be 28.34. Did anybody get that for option A? 28.34?
I just didn't put the compound in there.
Okay, so you didn't fill up this down. Okay. So 28.34. So what we're going to do is we're going to keep that in mind here. 28.34. That's that number of compounding periods. Write as many decimal places as you want. Times 110. That's going to be the total cost, right? Okay. And what do you get there? Should be about 31.17.40. Okay. All right. So with this one here, we have a smaller present value, or smaller principal here to pay off, but we have a higher percent. So, how's that going to work out? Well, the number of payment periods is pretty close to being the same, but really we're paying just a little bit longer to pay that off, right? So to get all of that gone is 28.92 months. So times 110. So this one would be 3181.71. Anybody get that answer? The second one? Okay, great. So that's how you find the total cost with the different kind of options. Okay, so different credit cards have different different percents. They have different special offers, in-store credit, and so on. I've done both. I've bought things on credit card. I've also used the in-store credit card. Lots of times, like if you go to some of the popular places like Rona or Home Depot, or you go to Visions, or you go to something like that, and you're going to make a big purchase like this, and you're going to do it anyways, they might say, hey, you know what, we have a special offer right now, which is 10% back if you use our credit card. If you apply today, you get 10% off your first purchase. And I've done that before, right? And that sometimes it works out really good. You can cancel that credit card as soon as you're done paying that off, or don't use it again especially if it has a fee or of some sort. So you have to take that into account. But anyways, so that is the first example there. Explore the math here. Okay. Any questions about that? Okay, so that's what 2.2 is about. It's kind of exploring credit card use. I'll get you to look at the in summary there for 2.2. Okay, and just take a moment to read that. We won't do any more examples, but just take a moment to read that. Okay, so we're going to combine 2.2 and 2.3. 2.3 is solving problems involving credit. So we're talking still about credit cards and that sort of thing, but we're going to add a couple things, terms here that you may not know. So let's take a look at this. Okay, so the investigate the math here says Liam wants to buy a carving by Inuvialuit artist Eli Nozagaluak. I did not read that over earlier. It probably would have helped me. He thinks it will cost about $3,900. Is considering two credit options. So a line of credit, okay, which has a limit of $10,000, an interest rate of 2% compounded daily, and that is 2% above the Bank of Canada prime rate, which is currently 0.5%, let's say, to be repaid in 16 monthly payments. Okay? So what is a line of credit before we move on here? Line of credit. A line of credit is a pre-approved loan that offers immediate access to funds up to a predefined limit. So there's always a limit there based on probably your credit score or how well you've done in the past in paying off your loans and that, with a minimum monthly payment based on accumulated interest. A secure line of credit has a lower interest rate because it's guaranteed against the client's assets, usually property. Okay, so a secure line of credit, usually there's some kind of collateral there that the bank takes. Okay. Now, what's the Bank of Canada prime rate? The Bank of Canada sets a basic rate, and then institutions can set their rates above that at varying percents, depending on whatever they want. But it's usually based on this prime rate. So if interest rates in general, if the Bank of Canada lowers the interest rates, what it's trying to do is it's trying to stimulate the economy and trying to get more people borrowing money so that they can buy things and sort of get the economy going. If it's too easy for people to borrow money, if the bank rate is too low and people are taking these big loans because they don't have to pay as much interest, and the ability of people to pay that back is in question, then the Bank of Canada will say, okay, we need to raise these rates because we need to cool it off a bit. We don't want so many people borrowing all this money because they're going to get into trouble, and really things are being traded around, bought and purchased and sold and all this stuff with not real money. So we're getting a little bit out of control here now. So the Bank of Canada will try and control the nation's economy by changing this prime rate. Okay, so that's what when you take a loan, they'll often base this on the prime rate. And if they say interest rates are high right now, that's what they mean. They mean the interest rates literally are high because the base rate is maybe higher than it was before. Or if interest rates are low right now, it's because of what the Bank of Canada has done. Okay, so option number 2 here that he's considering is a straight bank loan, 4% compounded monthly, to be repaid in one payment at the end of the term. Right. So Liam chose the bank loan when he found out that the interest amount would be the same as he would pay if he used the line of credit. Okay, so again, a lower percent. This one's compounded daily. So it's 2 plus 2.5 there. This one is 4 compounded monthly, so on. So you could do the math there and figure out which one would be better. So the question here would be, what is the term for Liam's bank loan? So, to have it paid all off, how long will that take, and how much interest will he end up paying if you use the line of credit, and so on. So there's questions associated with that. We're not going to do this example right now. You can do this on your own if you would like, but I wanted to introduce these two terms for you especially. So any questions about those, line of credit or the Bank of Canada prime rate? Because we will do an example here, so let's do an example or two from this section. All right, so example 1, take a look at example 1. Meryl and Kyle are buying furniture worth $1,075 on credit. They can make monthly payments of $75, and they have 2 credit options. Which option should they choose? Explain. So option A says the furniture store credit card, which is offering a $100 rebate off the purchase price and an interest rate of 18.7% compounded daily. So again, this is much the same as what we did in the previous section. A new bank credit card, which has an interest rate of 15.4, but no interest for the first year. Okay, so as the problems get a little bit more complex, this is an example here where you have to consider this option B is a little bit different. You haven't seen this yet. Okay, so there's no interest for the first year. All right, so option A is pretty straightforward, right? You get the rebate, you plug everything into the calculator, blah blah blah. Okay, you get the number of monthly payments is right here. Option B, okay, look at option B, the new credit card. So if there's no interest payments the first year, you really don't even need to use the calculator. You have 12 payments of $75, and that just comes straight off the total. Whatever is left okay, after that first year with no interest, whatever is left, so the $900, right, that's what they've paid the first year, $75 a month, then you take that away from the original amount. Now this amount of money is going to start accumulating interest, and that's where you pick it up from, okay? So again, just like section 1.6, where there was different, different situations, and you kind of had to piece it together a little bit, it's kind of similar here, all right? So that's example 1, where it's like, what happens if you have no interest the first year? Well, if you can pay it all off, that's great. But if you can only make a certain amount of money for payment, then you might have a little bit left over, and that little bit then you'll get charged interest on that. Okay. So again, I'm not going to go through every single step here, but I'm just going to run through that example and just kind of talk to you about that. The second example that I wanted to talk to you about, I think, was example 4. So if you can zip ahead to example 4 here, I want to talk about debt consolidation. Debt consolidation, which honestly is there's no I don't think there's an actual specific definition for that, but we should talk about what debt consolidation is. So write this down. Debt consolidation. Okay. And let's read through the example, and then we'll be able to jot down a definition once we understand this example here. This will help us. So, example 4 says this. Nikki wants to be debt-free in 5 years. She has 2 credit cards on which she makes monthly payments. So here's card A. She carries a balance of $2,436.98, and it has an interest rate of 18.5%. And of course, it's compounded daily, which most credit cards are. Credit card B has a balance of $3,043 and an interest rate of 19. So Nikki has qualified for a line of credit at her bank with an interest rate of 9.6. So check out these interest rates right now, right? And check out this interest rate, all right? It's compounded monthly. It has a credit limit of $6,000. So she plans to pay off both credit cards by borrowing the money from her line of credit. How much interest will she save? So let's stop for a second here. Okay, the line of credit is not like a credit card. You don't make purchases on a line of credit. You take money if you have a line of credit and you pay off something else. So she is going to take this money from a line of credit because of her history and relationship with the bank. They're giving her a line of credit that she can have that money at a low interest rate to pay off higher interest rate loans. And so that's what she's going to do. And debt consolidation would basically mean debt is the things that you owe, right? So you owe money from credit cards or from other loans. Consolidation, that word means to bring everything together into one, okay? To consolidate. So it means to bring it all into one spot. And so she's going to take the current balance from each. She's basically going to pay it right off so that those credit cards are out of the way. She's going to totally pay it off. Now she has to turn around and deal with the line of credit, right? She's borrowed a certain amount of money, and she has to pay that off now. But because it's at a much lower percent, it's far more attractive. So from now on, she's going to be paying far less interest. Does this all make sense?
Yes.
Okay. So debt consolidation, line of credit, why she would do this situation. Are we understanding this situation where she's at?
So you were saying it takes a while to get a line of credit?
It depends. I don't use line of credit, so I haven't really been there, to tell you the truth myself. But yeah, if you have I'm assuming that if you have a relationship with the bank, that you have a card, let's say, or you have a bank account or something like that, they will say, hey, you're a customer of ours. We know you have all your money in our bank or whatever. You've used our credit card. You paid it off faithfully. Here you go. We're going to offer you this. You can have a line of credit at a low percent so that you can save yourself some interest on something else. So yeah, I think it would be just a matter of you'd have to phone your bank or go in there and say, hey, I want to pay off something. My car loan, it's at 8.9%. Line of credit, maybe let's say it's 5 or 3 or whatever. Can I pay you guys instead of paying GM, right? That kind of thing. Make sense? Okay. All right. So let's just go through this. Again, I'm not going to go through the calculator here with you. We've done this a lot of times, right? This kind of stuff. I think you're fairly comfortable with it. So what I'm going to do is just going to go over what you would do and how you would find that out. And if you want to try this yourself, here the numbers are right here in the solutions, okay? So if the debt was consolidated, she's taking the individual values, right, the amounts, and she's combining them together. So this is the total amount that she would have to pay off. So in essence, that's the amount that she needs to take from her line of credit, right? This is the amount. So the payment amount is unknown. We fill everything in, payment periods, the number of payments. It's monthly. She wants to be free in 5 years, right, of this. And so it's 60 months and so on. Plug all this in. Now, the payment amount. So what you're actually trying to figure out is what is my regular payment going to be, right? So it's 115.36 and so on, total interest. Okay, so she's finding out kind of how much she would have to pay for interest if it's consolidated. The second part would be to compare if she kept on with those credit cards and had to pay it off just kind of normally, what would that look like? So if credit card A, if it was not consolidated, she would take this this money at a very much higher percent in 5 years. She'd find out that her payment amount would be $62 on that amount, and the total interest would be $1,300 for that one balance. She would do the same thing for credit card B, okay, at 19%, and the payment amount that she's calculated would be $79. Total interest here would be $1,700. So you add those two together, okay, and she's paying interest of $3,035. So what was the other value? Interest here, $1,400. So it appears that she's paying quite a bit less interest if she can take that option. Now, yeah, okay, where was I? Okay, down here. So there's the two values of interest. So she's going to save $1,500 over 5 years just in interest by taking sort of this other option. Okay? Debt consolidation. Okay? Line of credit. Bank of Canada rate. Those are the three new things for this section. Any questions? All right, so go ahead and take a moment here to look at the in summary, the key ideas and the need to know there. Okay, let's take a few moments to read that.